Nevada wears its prosperity on neon shoulders. The Strip glitters and headlines shout boom. But beneath those lights, the housing story is quieter and riskier. In February, the Las Vegas Metro's median list price hit $469,974, even as inventory climbed to 7,447 active listings, and the share of homes showing price cuts rose to 27.3%. Homes are staying listed longer, roughly 47 days on market, a sign that headline prices and market footing are diverging. Tonight, we follow the data into neighborhoods, boardrooms, and policy halls to ask, how stable is this market really?
Las Vegas is two markets at once. The luxury tier is red hot. 800-plus single-family homes priced $1 million plus, representing about 15% of for-sale inventory. While the working market faces an affordability squeeze, a typical pair of hospitality workers earning about $110,000 before tax can't comfortably buy the average $400K home. That split matters. Headline averages are propped by high-end sales, while the majority of residents are crowded into rental markets or priced out entirely. When your market is bifurcated like this, risk hides in the averages.
Contracts are breaking, and that shift changes bargaining. Redfin's national report found 14.3% of U.S. purchase agreements were canceled in April. Las Vegas's rate was 18.6%, nearly 1 in 5 deals. The causes are simple but serious. First, financial strain. Mortgage rates spiking above the 6% range, averaged 6.85% in June, pushes monthly costs sharply upward. Second, a flood of new listings gives buyers options and confidence to step back. Walkaways lengthen sales cycles and hand real negotiating power to buyers.
Policy choices are the difference between a patchwork market and community collapse. Opinion and analysis in your documents warn that proposed federal cuts to HUD and the conversion of rental aid into block grants would strip protections. The Emergency Housing Voucher Program has helped 60,000 households, but available funds, originally projected to last longer, could be exhausted by 2026 without action. In Nevada, changes to HUD funding, Medicaid rules, or SNAP support would ripple into evictions, school instability, and pressure on local hospitals. This is economic math and human consequence in one.
Markets remember trauma. Las Vegas is built on resilience, tourism, jobs, and fast rebounds, but the numbers carry a memory of extremes. Since 2000, the largest recorded median drop in the valley topped 63.9%, and recent studies rank the metro among the nation's most volatile, with a better than 40% chance a buyer would at some point see a price cut greater than 5%. That history matters, because volatility changes behavior. Sellers delay, buyers hedge, lenders tighten, and what looks like a steady headline can fold quickly when credit or sentiment shifts.
Supply is not just one number. It's inventory, permits, new builds, and sellers finally relenting. Las Vegas's active listings climbed sharply from pandemic lows, but still sit below the pre-pandemic watermark of 9,000 listings. Meanwhile, annual sales have eased. A market that once averaged touching 45,000 transactions now hovers near 32,000 a year. Builders are cautious. Permits have ticked up in pockets, but large-scale starts are uneven. The result? Growing choice for buyers, slower velocity for sellers, and a market that can tilt if construction or demand changes quickly.
Money matters more than headlines. Mortgage rates have moved the market, the 30-year fixed rate rising into the mid-6% range, averaging roughly 6.85% in June, adds hundreds to monthly payment formulas once taxes, insurance, and HOA fees are included.
That payment shock helps explain why many homeowners are locked in to low pandemic-era rates and why buyers cancel contracts when final numbers bite. Financing, more than price per se, is the throttle, and it's what turns headline numbers into real decisions.
Communities are the unstatistic in every spreadsheet. Nevada's social safety net is a major demand anchor. Approximately 738,000 Nevadans rely on Medicaid, and more than 500,000 receive SNAP, supports that keep families housed and food on the table. Policy shifts, block granting rental assistance, cutting HUD staff, or narrowing Medicaid would not only harm households but alter housing demand and developer financing, tightening credit for affordable projects that the region depends on. In short, budget choices are housing choices.
Sellers are learning the market's new grammar. When buyers walk away and price cuts rise, listing strategies change. In February, roughly 27.3% of Las Vegas listings showed price reductions, a visible sign of seller recalibration. Some owners delay listing, waiting for better demand. Others price aggressively to avoid long holding costs. The end result is a more surgical market, where timing and pricing precision decide outcomes. For the seller who misreads the rhythm, the cost is not just commission, but months of carrying costs and potential deep discounting.
Investors watch the margin. Institutional buyers and local landlords both change market dynamics. Some private equity players and out-of-state investors target cash flow neighborhoods, but higher financing costs and tighter underwriting raise the cost of capital. Cap rates, once compressed by cheap debt, are expanding. The math that made rehab flips attractive at 3 to 4% mortgages is different at today's 6 to 7% rates. That recalibration reduces speculative demand and shifts returns toward long-term, income-focused strategies, but also raises capital costs for small developers building entry-level homes.
The city is many cities, micro-markets. The Strip's resort-adjacent condos, the fast-growing suburbs to the west, and the older inner-ring neighborhoods each tell different tales. Downtown condo closings can mask weakness in the suburbs, where the average buyer is more sensitive to rate changes. Conversely, a sudden local employer layoff in a suburb can depress demand for months. Reading the market requires block-level data. A zip code average is an eyebrow raiser. A street-level trend is a decision-maker.
Renters are the market's safety valve, and pressure is building. Vacancy rates that once gave landlords negotiating leverage are tightening in select corridors, while rents in many neighborhoods rose faster than wages over the past 3 years. That imbalance pushes longer commutes, pressure on transit, and an increase in involuntary moves. Policymakers often talk about ownership. The immediate pressure is rental stability, and when rentals snap, displacement follows. Tracking vacancy, median rent, and wage growth together is critical for understanding where the pain will hit first.
Foreclosure headlines sell, but the real early warning signals are delinquencies and forbearance paths. In Las Vegas, the market has so far avoided a wave of mass foreclosures, yet lenders report rising late payments in certain cohorts, particularly recently purchased homes with higher-rate loans and investors carrying multiple properties. Mortgage distress often shows up first as 30 to 90-day delinquencies, then as strategic short sales or lender-mediated workouts. Watch those short-term delinquency trends and FHA/VA exposure. They tell whether the market is bending or breaking.
New roofs and new lots matter more than headlines. The pipeline of permitted units indicates where supply will arrive, and in Nevada, starts have been uneven. Recent permit data shows localized upticks in master-planned communities, while infill and small lot starts lag. That mismatch creates timing risks. If permits convert slowly into starts, the market can tighten unpredictably. If starts accelerate in a narrow band, local oversupply and price pressure can emerge. Watch permits to starts conversion and builder backlog as leading supply indicators.
Nevada's economy is especially exposed to tourism cycles and hospitality employment.
A sudden dip in convention bookings or a slowdown on the Strip ripples to demand for housing among service workers. Local employment trends, hiring, layoffs, and hours worked in leisure and hospitality are near real-time signals for housing demand. When employers trim shifts, stability wobbles. Renters get squeezed, buyers delay, and localized vacancy rises. For Nevada, tracking weekly job postings, hotel occupancy, and payroll snapshots is as important as monitoring prices.
City halls and state capital offices can blunt a downturn by funding emergency rental assistance, speeding permits for affordable builds, or offering tax incentives for workforce housing. Nevada's policy mix matters. Local measures that accelerate small lot construction or protect rental stability soften shocks. But policy takes time and funding. Short-term interventions like rental assistance can prevent displacement today, while zoning and incentives shape supply for years. Watch both immediate relief spending and medium-term zoning changes to judge the system's resilience.
Interest rate swings rewrite affordability overnight. Using a $400,000 mortgage as a baseline, a move from the low-rate era to today's mid-6% band changes monthly principal and interest by nearly $1,000, money many households lack. Stress tests dealers and lenders run show how a 1 to 2% rate swing can push otherwise viable buyers past qualification thresholds. For Nevada, small rate moves aren't academic. They alter buyer pools, lengthen sale timelines, and raise cancellation risk. Watch payment sensitivity charts. They're the clearest real-time stress tests for the market.
Lenders set the margin for recovery or contraction. After 2 years of rising rates, underwriting is retightening. Higher debt-to-income checks, larger reserves, and stricter investor-lender matrices. Local banks and credit unions with concentrated exposure to commercial real estate or to speculative development face higher tail risk, and even conservative residential portfolios can be stressed if regional payrolls dip. For viewers, the salient indicators are not only mortgage rates, but lender approvals, denial rates, and institutional exposure, data lenders often report first.
Not every corner of a metro reacts the same. In Nevada, there are resilient pockets, neighborhoods with stable employment, strong owner occupancy, and steady demand that consistently show shorter days on market and smaller price swings. Examples include resort-adjacent enclaves and certain master-plan subdivisions where jobs, schools, and transit align. Profiling these pockets matters for buyers and small developers. They are the micro-markets that protect equity and offer predictable rents even when broader averages wobble. We'll look at 3 contrasting pockets to illustrate what stability looks like in practice. If you want one dashboard to watch, make it simple. Cancellation rates, active inventory, share of price cuts, days on market, and mortgage approvals. Those 5 indicators together show whether supply, demand, or credit is changing first. For buyers, get independent pre-approval, stress test monthly payments, and ask sellers about cancellation patterns. For sellers, price to the market, not to fear. For investors, model cash flow at multiple rate scenarios. For policymakers, prioritize short-term relief and medium-term supply levers. These are practical, calibrated steps to survive a fragile cycle.
If today's report helped you see the hidden trends in Nevada housing, subscribe for regular updates. The Nevada Real Estate Report. We deliver data-driven dashboards, neighborhood deep dives, and tips for buyers, sellers, and investors. Hit subscribe, like the video, and share it with someone who needs this insight.